So can we wait for another 5 minutes and start the session? Attendees are still joining in.
Yes, sir. Yeah, we can do that.
I think we can start.
A very pleasant evening to all of you and very warm welcome to this webinar. Firstly, I would like to extend a note of thank you to everyone for becoming part of this session and gracing it with your presence. I am Sarish, convener of Corporate and Allied Laws Committee of Karnataka State Chartered Accountants Association and your MC for the day. It's my pleasure to welcome each and every one of you to the most awaited event, Equity Linked Funding Instruments and Special Terms in Funding Arrangements. In this webinar, we are going to understand special terms in funding arrangements. This webinar also covers practical application, focused real-life illustrations with comprehensive learning experience. I also extend my thanks to KSCA, Corporate and Allied Laws Committee and the event organizers for their enormous cooperation in organizing this event. Before we start our session, I request Chairman of Corporate and Allied Laws Committee, Chairman Naveen sir, to address the participants. Or to CA Naveen sir. So you are in mute, sir. You are in mute.
Yeah, thank you, Sharish. Good evening, all. I'm truly delighted to welcome each and every one of you to this esteemed, informative, and insightful webinar hosted by our Corporate and Allied Laws Committee. This is a 2 hours session, and which has been meticulously organized to provide you with the wealth of knowledge related to equity funding and how to draft the funding and what are the points which has to be considered while drafting the agreements. First and foremost, I would like to express my sincere gratitude to all of you for taking the time to join us here today. Your presence underscores the importance of the topics we will discuss and the relevance of the subject matter in the world of equity investments. Our committee has painstakingly curated this event with the intention of fostering a deeper understanding of the framework governing the equity funding instruments. So I request each attendee to post your questions in the Q&A tab, and we shall take up all the questions at the end of the sessions. I would like to inform you, all of you, that our committee is coming up with interesting webinars in the coming months on internal audits, accounting standards, etc. I request all of you to keep a close watch on our website. Once again, thank you for joining us today. Let us make the most of this opportunity to learn, share, and grow together. I wish you all a fruitful and enlightening webinar. Now I request CA Sharish Gade to introduce our speaker. Thank you.
Thank you, sir. Moving on to today's speaker, it gives me immense pleasure to welcome today's session speaker, who is none other than CS Narayan Desai from Bengaluru. He is a fellow member of ICSI and a company secretary in practice, having his office in JP Nagar, Bangalore. He is a member of board of directors of foreign subsidiaries and Indian companies as well. With over a decade of experience in working with companies, helping them to take care of secretarial compliances, he has contributed to the compliance growth of foreign subsidiaries, listed Indian companies, government companies, and startup at large. CS Narayan Desai is an expert in company law, investment and funding compliance, ESOP implementation, and dispute resolutions, and being a dynamic, experienced, and progressive corporate consultant. He is helping his clientele in order to maximize their value and has worked on number of funding compliances in all sorts of transactions such as equity, CCPS, convertible debt instruments, including drafting and vetting of term sheets, shareholders agreement, and transaction negotiations. He proudly belongs to a place called Gunda, located deep in the thick forest about 45 kilometers from the nearest town Dandeli in Uttara Karnataka district. He has previously worked at PS Rao and Associates Hyderabad, a leading firm of company secretaries, and has been a faculty for company law and allied laws in various coaching institutions for CS and CA. He is also a speaker at various forums like ICAI, ICSI, ICMAI, study groups, CPE chapters, etc. on corporate law matters, and a continued student of company law. He has a bachelor's degree in business administration from Dr. A.V. Baliga College of Commerce and BBA Kumta, affiliated to Karnataka University, Dharwad, and has studied law from GK College of Law, Hubli, affiliated to Karnataka State Law University. Sir, we are truly blessed to have a versatile personality like you in this program, and we also seek to have your association with KSSCA in the years to come. We request viewers to please enter your queries on the Q&A box on your left side of the screen. Relevant queries will be taken up for discussion by our speaker towards the end of this seminar. Now, with this brief introduction, I request CS Narayan Desai, sir, to please take over. Over to you, sir.
Thank you. Thanks for the introduction and this opportunity to present the little knowledge I have on the funding related aspects. I have tried to prepare a small presentation which I will present before you. I hope the screen is visible to all of you. So, today's topic that we have is equity linked funding instruments and special terms in funding agreements. This itself says the corporates, when they start with their idea of coming up with any product, technology, service, how do they start? What are the milestones that they achieve? And there is some level that every corporate ultimately want to be a listed entity, listed in BSE, NSE, things like that and all. But what are the steps before that? We have promoters funding, we have angel investors. All these are fancy words these days we are able to hear. Private equity funding, VC funding, all these points which we have been kind of hearing on a daily basis almost, whether we are advising our clients in terms of funding requirements, or any of our friends and family who are running the businesses are able to achieve these investments. So when it comes to investment is not an easy task. Self investment is one thing, because it's your money, you are investing into your businesses, and no one is you're answerable to no one basically. But when it comes to investment from someone else, that's where the private limited company, public limited company, the company form of business comes into existence. It is the primary nature of the company form of business, wherein it says the amount of capital that is required for any business is invested by somebody called shareholders, whereas the business is managed by somebody called directors. The ownership is different and the management is different. The moment when these ownership and management are two different aspects, we get to hear lot of things like permission from the investors, the rights and regulations that the directors has to follow, the rights of specific investor who has invested significant amount of investment in the company. All these are the different aspects that are generally heard in the funding market. With this background, let me start the basic concept of equity linked funding, the different types of instrument used in, as well as the special terms in the funding agreements. So I propose to cover the types of funding, different types of instruments that are used in raising these funds, comparative analysis of these instruments, and a little bit touching upon the statutory requirement of issuing these the different types of instruments. And then in the second half of the session, we'll move on to the types of transaction documents, the special terms used in these transaction documents or funding agreements. And since we are all accounting professionals or someone who are related to accounting professionals, the provisions relating to accounting and audit requirements, and then the floor is open for questions and discussions. So to start with, the first one, types of funding. So you have already seen these are all the different topics that I'm going to cover. But when I say none of these topics, none of these points that I'm going to cover are completely new to any of you. I'm sure all of us, we have heard what is equity capital, what is preference capital, what is debenture, what is shareholders agreement, what is, TAS 3, MGT 14, 100 other stuffs. But for a moment, for maybe next 1 hour 45 minutes, let's assume that we don't know anything, and let's start discussing on these aspects, because if your cup is full, you cannot pour more tea into it. That's what Osho said. With that background, I'll move on to the first point, types of fundings. Yes, as screen says, there are 4 types of funding I can categorize. One is self-funding. Self-funding is an area where I invest my own money into my own business. It is not only just money, but also the efforts and the idea behind the product. So this is probably categorized as self-funding. The second type of funding that we have is equity funding. Equity funding is when one business person probably starts a company, a private limited or a public limited, then gathers his other friends or family members who are ready to join hands with him as co-founders. They come up with a equity funding. These are called as the ultimate owners of the company. They are the real owners, ultimate owners of the company, who share common or ordinary rights. What do you mean by this common or ordinary rights? The rights available to all the shareholders of the company, whether he is shareholder holding 1 share in the company or shareholder holding 99% of shares in the company, both of them enjoys the same or common rights. That's called as common right or ordinary rights. So these equity shareholders will enjoy the common or ordinary rights. Hence, they called as ultimate owners of the company. And this is what equity funding is. Another type of capital is convertible capital. What is this convertible capital? It may not be equity today, meaning the investor is investing into the business of the company. He is subscribing certain category of instruments, but that may not be equity. But if not today, tomorrow, those instruments will get converted into equity. For example, preference shares, convertible debentures, notes. Why so? Why anyone has to subscribe to convertible capital but not equity funding? In equity funding, we will also see the relevant slides in the subsequent discussions. In equity funding, what happens is the valuation is fixed and they enjoy the common and ordinary rights. But in case if your valuation is not fixed, if you don't know what should be your value of your entity, point number one. Point number two, if there are any special rights that you want to give it to your investor, then equity funding may not be the right method. Then the business owners will go for the convertible capital method, where preference shares or debentures will be issued, where the conversion will happen at a future date. And as and when conversion happens, the equity will be given to those shareholders, those investors. Until such time, they also enjoy the special rights. Because it has to be converted into equity tomorrow, it is also called as quasi equity. So this is another category of funding. The fourth category of funding is again debt and grants. A company may avail loan from banks, financial institutions, even from private parties in the form of loan from directors and shareholders and all. Or there can be even loan from intercorporate deposits, we call it as loan from another company, or even non-convertible debentures. The third category I said convertible capital, there also we have a debenture, but that's a convertible debenture. It's a quasi capital, I said. If not today, tomorrow it has to be converted into equity. Whereas a debenture which is not convertible, or it is also called as redeemable debentures, these are the category of debt funding. So in our today's discussion, we will not look into the self-funding and debt funding. We will mostly focus on equity funding and convertible capital. Moving on, what are the instruments under these two categories, equity capital as well as the preference capital? What are the instrument or convertible capital? What are the instrument generally being shared by the or issued by the companies? Let us try to see. Number one starts with equity share. As I already mentioned, equity share are common shares issued to the shareholders of the company. There are two types of equity shares. Number one, equity shares with voting rights. Another one is equity share with differential rights. What do you mean by these shares with differential rights? Differential rights as to dividend, voting, or otherwise. This is what law says. For example, as presented before your screen, there could be a possibility where company issue 1,000 equity shares of rupees 10 each, where one share is equal to one vote. This is the equity share with voting right. So in this case, the dividend is also proportionately being paid according to the shareholding in the company. The voting also, he will have that many number of votes, as many number of shares that he owns. Whereas the shares with differential right is, it can be anything in however the weighting, it can be tailor made ultimately. For example, 100 equity shares of rupees 10 each, but each share will have 20 votes. So though he has only 100 shares, he will end up with having 200 votes in the company. Sorry, 2000 votes in the company. Or there can be another way. It says, though he has only 2% in the company, he is entitled for 20% of the dividend. So the differential rights can be with respect to dividend, voting, or otherwise. So this is all about equity shares. Moving on, we have another category, preference shares, another instrument, preference shares. Preference shares are generally called as shares having preferential rights with respect to dividend and repayment of capital. So we have also seen this 10% preference shares, 0.001% preference shares. What this denotes? As I said, preference shares carries preferred rights with respect to dividend or repayment of capital, which means each preference share will carry a mandatory amount of dividend. That could be 10%, 20%, or whatever it may be, or as low as 0.001%. And when you say 0.001% or 10% preference shares, the preference dividend is represented in the form of nomenclature of preference shares. Like in the screen, you see 0.001% preference shares, which means those preference shares are eligible for a dividend of 0.001%. And another way of another preferred point in the preference share capital is, or preference share is, liquidation preference. Repayment of capital is nothing but liquidation preference. So these preference shareholders will get preference over the equity shareholder in the event if company gets liquidated. So their capital will be paid first before the others are paid, before the equity shareholders are paid. Since we are also speaking about the funding instruments, and this is the reason why an investor probably wish to have preference capital instead of regular equity, is he wants to probably govern the liquidation preference here. So preference shares allow you to design the liquidation preference or repayment of capital the way however you want. Like the clause which is in front of you on the screen says, in case of liquidation events, the investor should get higher of the following. What is that? 120% of the amount invested or the fair value of the investment. So here the investor is making sure that he gets minimum of 120% return on his capital. So these kinds of the clauses can be designed for preference shares, which is not possible in case of equity shares. So moving on, what are the different types of preference shares we have? We have convertible preference shares. When we say convertible, it can be compulsorily convertible, optionally convertible, at the same time fully convertible or partly convertible. Another category of preference share is non-convertible. It is also called as redeemable preference shares. These preference shares could be convertible or non-convertible, but at the same time, it could be participating preference shares or non-participating preference shares. We know what is convertible, what is non-convertible. What we mean by participating preference shares and non-participating preference shares. Participating preference shares are those preference shares which are eligible for participation in the surplus in addition to their regular dividend, or even in case of repayment of capital. So if 10% preference shares are participating preference shares, first of all, they are eligible for 10% of dividend. And once their dividend is paid, if the company is also declaring the dividend to the equity shareholders, these participating preference shareholders are also eligible to participate in the equity dividend. So that's called as participating or non-participating. Then we also have the cumulative and non-cumulative category. Cumulative preference shares are those preference shares where the rate of dividend that we have declared need not be paid in the same year. It can be cumulative. It can be paid in the subsequent years. So the dividend can be added up to the next year. Whereas non-cumulative is where the dividend is not paid in a particular year, cannot be carried forward to the next year. So these are all some of the basics of preference shares. Then we have another category of convertible instrument called debentures, which are used for raising the funds. One of the popular instruments that I can say in the recent market, specifically in the startup ecosystem. So what is this debenture is? Debenture is not a capital, but still a capital. Why it is not a capital, but still a capital? Debenture takes the color of debt till the time it gets converted. Once get converted, it becomes a capital, but still that time it is not a capital. But if you go back in the previous slide, if you see the preference shares that we have seen are capital from the day one. It's just a preference capital, not equity. But for all net worth purposes and other things, preference is also called as a capital. Whereas debenture, that's not the case. Debenture comes with a debt color in the beginning. The moment when debentures are converted into equity or equity instruments, that can be called as a capital. Again, even in the debenture, we have convertible, non-convertible. Again, in the convertible, we have compulsorily convertible, optionally convertible, partly and fully convertible. The debentures can also be secured or unsecured debentures. Secured debentures are those debentures against which the company has created an encumbrance. Company has offered a security, that's called as secured debentures. Unsecured debentures, like unsecured loan and secured loan, unsecured debentures are those debentures against which there are no security guaranteed by the company. But when we explain all this, I also draw the attention of everyone to the specific provisions of the Companies Act. So companies are now freely allowed to issue debentures with either converting provision or non-converting provision, secured or unsecured. This is fine. The provisions of Section 71 and all are very clear on that. But there is a provision under the Companies Act which speaks about deposit. A debenture which is either secured or fully and compulsory convertible is exempted from the definition of deposit. If you see the rule 3 of companies acceptance of deposit rule, it gives the definition of deposit basically, which says it gives a negative list. Basically, everything and anything that is received by the company is a deposit, except the following. He gives 1, 2, 3, 4 points. One of that point is the debenture which is fully and compulsory convertible, or a debenture which is secured is exempted from the deposit, which also means a non-convertible, which means a redeemable unsecured debenture, also takes the color of deposits. So one has to be very cautious while issuing the debentures. Either debentures has to be fully and compulsorily convertible into equity, or debentures has to be secured to escape from the deposit regulation. Otherwise, the deposit regulations are also applicable for the debentures. The other types of instruments that we have for raising the funds are warrants. Warrants are options given to the holders of warrants to subscribe to the shares of the company at a predetermined price. Sometimes warrants are detachable warrants, along with share warrants are also given, and warrants can be separately traded. So there are number of regulations, along with warrants, which has to be observed if the company is proposing to issue warrants. But in simple words, warrants are those which gives option to purchase the shares of the company at a predetermined price. Next instrument that we have is convertible notes. In popular, it is also known as CN these days. Only eligible startups can issue convertible notes, that too with a minimum ticket size of 25 lakhs. So these convertible notes are governed by the RBI rules and regulations, where company can raise funds from resident and non-resident investors. Only eligible startups can raise funds with a minimum ticket size of 25 lakhs. Then we also get to hear about something called iSafe. What is this new instrument? I don't think any one of us, we have studied in any of our professional courses or anywhere that an instrument called iSafe. We have studied something called warrants. We have studied something called convertible notes, preference, debenture, equity. All are familiar. What is iSafe? SAFE stands for Simple Agreement for Future Equity. So this itself says there are no instruments separately designed here. It is an agreement, a simple agreement in which company agrees to investor that investors will be allotted with certain number of shares at certain valuation on a future date. Now this is called as SAFE, Simple Agreement for Future Equity. In India, we don't have a concept of iSafe, or rather in India, we don't have a concept of SAFE. The money that is received has to take a color of either equity, debentures, CCPS, warrants, or convertible notes, failing which it can be called as a debt. So for the purpose of Indian requirements, there is a new concept called iSafe. Though it is a new nomenclature as such, iSafe is nothing but again either CCPS or a debenture. It's just the startup ecosystem has got some new nomenclature, new name in their funding instruments. So these are all the various instruments that can be used for raising the funds. Moving on to compare these instruments, what is best and what is not best. Of course, everything is best. It's not that something is bad, but at the same time, if I can say, we can select any of these based on certain pros and cons that I can present before you. Starting with equity. Equity, as we already seen, mostly common ordinary rights. There cannot be any special rights. So from the company point of view, it is an advantageous. You need not have to give special rights to investors if at all you are issuing equity shares. Dilution is fixed. When I say dilution is fixed, The valuation of the company is fixed. There is no threat that investors will get more shares in the company if company is not performing good and all, because the dilution is fixed, the valuation is fixed. There is no fixed return concept because this is a equity instrument where there is no dividend is guaranteed. The fixed return concept is not there, so company is not required to mandatorily adhere to the dividend requirements. And at the same time, the issue of equity shares increases the capital base of the company for all purposes. Let's say, for example, if company is going for a bank loan, company has security to offer and company has other assets to offer and all. But still, if company does not have the proper capital base, the banks will have lending ratio. They call it as lending ratio. So against X amount of equity, they can lend only Y. Maybe it is 1:10, 1:5. So if company has 1 crore of capital, they can lend up to 5 crores, irrespective of matter what amount of capital, what amount of security that the company can offer. So by issuing equity shares, the company can increase the capital base, thereby also can be open with banks and other things for availing more and more debts. So these are all the advantages of equity shares. There are disadvantages as well. The increased equity share requires the increased authorized capital. So each equity share can be infused only with specific authorized capital for that. Equity capital are permanent capital. Permanent capital means we cannot withdraw this capital unless there is a buyback of securities or a reduction of capital, which has to follow its own provisions under the law. Then we have another disadvantage: ownership is shared immediately. So if I'm owner of the company and I own 100% today, and if I take an equity investment from somebody tomorrow, I will end up with diluting my shares immediately. Now that makes probably in many cases harm to the promoters, founders, because they are diluting immediately without, and they may also lose the control over the company, because if more than 50% dilution is there, then promoters might not have any more control in the company. Another disadvantage is the provisions of Income Tax Act. Any amount of money that is received in the form of equity investment with a premium in it is required to be justified under Section 56, subsection 2 of the IT Act. And the amount that is received is also subject to justification under Section 68 of the IT Act. Both are very widely discussed provisions under the IT Act in respect of angel taxation and related aspects. So another type of instrument that we have is preference capital. Compared to equity, preference capital are advantageous to the investors, because investors can govern special rights in them. There are possibility of we giving preference in payment of dividend and repayment of capital. At the same time, it is advantageous to the company as well, because the rate of return, the dividend is fixed. Irrespective of company earning huge amount of profits, they need not share huge amount of dividend to the preference holders, because preference shareholders will have a fixed rate of return. The disadvantage are preference capital requires a separate authorized capital. The equity authorized capital cannot be used for issue of preference capital. So company need to have a separate authorized capital for equity and separate authorized capital for preference. And if there are different class of preference capital, each class need to have a separate authorized capital again. So this will increase the compliance burden for both issue as well as managing the preference capital. Since I mentioned that the preference capital has to be issued with at least a minimum amount of debenture, that is say 0.001%. So there has to be a minimum commitment of debenture. Even for this small amount of debentures, there has to be a same compliance that the company has to follow in respect of declaration of dividend, like see opening of separate bank account, depositing it in the separate bank account, payment of dividend within so and so time frame, and in case if the dividend is not claimed by the shareholder, transferring it to IEPF. All those compliances are applicable. So with equity, we don't have that. If you don't declare dividend, it is not applicable at all. Whereas in case of preference, we have to mandatorily declare the dividend, and hence increased compliance. Stamp duty at multiple stage. This is one of the another disadvantages. At the time of issue of preference shares, company is required to pay the stamp duty. At the time of conversion of preference shares into equity, at that time also company has to issue again pay for the stamp duty. So stamp duties are paid at multiple stages for the same amount of investment that the investor has made. And subsequently, again, the same amount of same type of disadvantage we have the IT provisions, justification of premium under section 56(2) as well as section 68. So these are all the different disadvantages and advantages of preference capital. Moving on to the debentures, if I can say, the biggest advantage in case of debenture is there is no authorized capital required. While the equity as well as preference capital require the authorized capital to be in place, the debentures do not require any separate authorized capital, thereby saving huge amount of stamp duty and MOA fees for the company in case if company is raising huge amount of funds. Another biggest advantage is the return given to the debenture holders, that is called as interest in case of debenture, is a deductible expense. Whereas in case of equity as well as the preference shares, the dividend, the return given to the shareholder is called as dividend there. The dividend paid is not a deductible expense in the hands of the company. Interest being deductible expense becomes more tax efficient in the hands of the company. So debenture is comparatively more tax efficient compared to preference shares or equity shares. And since the provisions of section 56 subsection 2 speaks about justification of premium collected on shares, I'm quoting the word shares, and the debentures are not shares per se, the premium collected on debentures need not be justified, can be one of the biggest argument under section 56(2), thereby escaping the applicability of section 56 subsection 2, these being the one of the greatest advantage of the debentures. There are disadvantages too. Even debentures have disadvantages. Of course, increased compliance for issue and allotments. Compared to equity, the debenture issuance requires lot more disclosures, lot more documentations, thereby making it more compliance issue. Then we have stamp duty at multiple stage, like how preference shares are subject to stamp duty at multiple stage. At the time of issue of debentures are also we have to pay stamp duty, and at the time of converting that debenture into equity in the subsequent period, at that time also we will end up with paying the stamp duty. Then debentures cannot contribute to your capital base. It is not a share till it gets converted. So if at all we want to increase the capital base, that is not possible by issuing debentures. And there is a disadvantage to investors as well. Debentures are not eligible for any voting in the general meetings. They can vote and participate in the only meeting of the debenture holders. Meaning, if investor who has invested significant amount of money wish to control any of the any of the decision making process of the company, it is not possible for him to participate in the decision making process because debenture holders are not eligible for voting in the general meetings. Next instrument is warrants and notes. These warrants and convertible notes, again, the advantage is there is no authorized capital required like the debentures. No requirement of justification of premium again because it's not a share, and again no immediate dilution as well. However, there are certain disadvantages or cons of these warrants are increased compliance issue. Not every company can issue convertible notes and all. I said only eligible startup, that too with a minimum ticket size of 25 lakhs of investment, can issue. Again, stamp duty at multiple stage and not a share till it gets converted into equity. And at the same time, no voting rights as well. So compared to debentures, we have the same types of disadvantages here. But the warrants and convertible notes have added disadvantages of increased documentation, and it is not so popular as well. And convertible notes can be issued only by eligible startup companies up to or minimum of 25 lakhs of ticket size. Then we have another instrument we discussed is iSafe. The advantage of iSafe is simple, less transaction document. As I already mentioned, SAFE is simple agreement for future equity. There are no instruments at all. Like in case of debenture, you have debenture certificates, preference certificate, or ROC compliance. You file MGT 14, PAS 3, you file 100 other returns. In case of iSafe, there is nothing. But iSafe, under the Indian requirement, will have to take the color of debentures as or preference shares. Hence, all the advantages and disadvantages that you have seen for preference capital and debentures are also available for, or also they are applicable for the ICF documents. If I can see these comparative analyses of equity, preference, debentures, notes, and ICF, it appears that the issuance of debentures for startups, private limited companies, even in case of public limited companies, are more attractive, compared to the others because of the tax advantages that it has got, as well as the documentation and dilution requirements that generally promoters come up with. If you can see the statutory requirements of issuance of these instruments, in case of equity, preference, debenture, and ICD, all four, we are required to check the reserve matters in the existing agreement. There might be a reserve matter in the articles of association. What do you mean by reserve matter? Reserve matters are those matters which require specific and affirmative voting of investors if company wish to take up the transaction. So we have to first check whether the company has any affirmative voting matters in its articles, whether articles of association is required to be altered or not. For issuance of equity share, there is no specific articles required in the AOA, whereas in case of preference and debenture, we need a specific articles mentioning that the company is eligible to issue preference shares. That is required in the articles of association. So if it is not there, we have to alter the articles and then provide. ICD is intercorporate deposit. There is no specific article required for that. Again, authorized capital is required for equity and preference, but that the same is not required for debentures and ICDs. Valuation report from a registered valuer, a professional who is responsible for valuation. Valuation report is required for equity. Valuation report is required for preference shares. Valuation report is also required for debentures, convertible debentures, whereas valuation report is not required for intercorporate deposits. Separate bank account. This is one of the another statutory requirement. If at all company is accepting investment in the form of equity, preference, or debenture, company is required to open a separate bank account, receive the application money in the separate bank account, complete the allotment formalities, and then move on to the utilization of funds. Passing of a resolution in board and EGM is required in equity, preference, and debentures. In case of ICD, the EGM requirements are there only in case if company is crossing certain threshold limits. Section 186 prescribes about the threshold limits. So only if the company is crossing those threshold limits, the shareholders approval in the EGM is required. Filing of MGT 14 pass 3s, these filings are required in case of equity, preference, and debenture, but not in case of ICD. Reporting of utilization. So in case of audit, in case of accounting and finalization of audit, whether the company has used the money for the purpose for which the same is raised is required to be reported. And that requirement is there for all the fundraise activities, whether it is equity, preference, debentures, or ICD. So these are all the various statutory requirements for raising funds using different types of instruments that we have seen. Now that we have seen what are the different types of transaction, what are the types of instruments that we can issue for raising the funds, whether is it sufficient for us to issue only the instruments and get the money? Will the investor be ready to pump in the money just because you are investing, you are giving the instrument? That may not be sufficient. As we discussed in the beginning, the strategic investor will always come up with certain specific requirements of governing his investment, be it in terms of governing his rights, putting certain obligations on the founders, promoters, or there may be information rights, or there may be affirmative voting matters. All these points he wants to govern. And generally, these points are governed in the transaction documents or funding agreements. So let us see what are the different types of transaction documents that are generally applicable in case of raising of investments. So to start with, the first type of transaction document that we are get to hear from the corporate world is term sheet. A lot of these startups these days, they say, hey, we have entered a term sheet with so and so investor, we are expecting so much of investments. What is this term sheet? Term sheet governs the basic terms of the understanding of the parties. It is non-binding. An investor comes and says, hey, I'm ready to invest 10 crores into your organization, provided 1, 2, 3, 4, 5 are satisfied. So this is a kind of soft commitment or a commitment given in writing, that upon company completing so and so conditions, investor may invest so much of money. Now this is a non-binding, as I said. An understanding of parties is reduced in writing. This is a term sheet. Generally, this is time bound. Time bound is like, this term sheet is valid for 1 month, 2 months. If no transaction is taken place within that 2 months or 1 month time period, the term sheet expires. So this is one of the important document in the funding transaction. Then we have second one is the share subscription cum shareholders agreement, or security subscription agreement. In short, we call it as SHA, SSA, or debenture agreements and all. These are all the agreements in which investor rights, investors protection matters, promoters obligation, companies obligation, covenants, undertaking, all these matters are covered. How investment should flow, for what purpose the investment should be used, what are the conditions of investment, what are the conditions, what are the critical aspects that the company has to follow after the investment, what happens if 1, 2, 3, 4 points are failed. Everything is governed under the transaction document called SHA, SSA, or debenture agreements. While the debenture agreement or the funding agreement is already in place, there can be another type of funding instrument called deed of adherence. What is this deed of adherence? If company already has the funding instrument or funding agreement, say company already has a SHA, and there is one person who is entering into the company as a secondary shareholder. One of the existing shareholder is selling his shares to the new shareholder, or investor is selling his shareholder, or there is a bridge finance. What is bridge finance? Company has already raised Series A funds, and company is in the process of raising Series B funding, but that may take another year or a year or two. Meanwhile, company wants to raise a small amount of funds, and they have already identified investor who is ready to pump in the money. Company may not again enter a separate SHA with him or separate funding agreement with him. What they can do is they can attach him to the same funding agreement with the help of deed of adherence. Basically, it's a 2-pager document in which we say that the terms of the so-and-so agreement is also applicable to the parties of this deed of adherence. Then we have another concept called addendum to the agreement. Generally, these addendum to agreements are used when certain specific provisions of the agreement is to be altered. Say, for example, the tranche is required to be altered, or some of the provisions of the investor rights are to be altered. The addendum is entered in that case. Another important document in case of funding instrument or funding compliance is amended and restated articles. So whatever that we have studied, whatever that we have drafted in the term sheet, shareholders agreement, deed of adherence, will not be statutorily bound in respect of the company unless that is also brought into the articles. Because in case if agreement is breached, then it becomes a civil matter. But in case if article is breached, then it is a matter of concern to the company, and petitions can be filed before the NCLTs as well, not just in the civil court. Hence, every investor would want to also alter the provisions of articles, incorporating the terms of the agreement into the articles. So these are all called as amended and restated articles. Once the provisions of articles are amended, the company cannot violate those provisions, because if it violates, it becomes ultra virus. And we have all seen what is doctrine of ultra virus. Then we have another transaction document called intercorporate loan. We have seen in the previous slides, ICD is one of the instrument, or one of the where the funding can be done. In case of ICD, intercorporate deposits, there can be intercorporate loan agreement. This is a loan agreement entered between lender and borrower, between two companies. Provisions relating to interest rates, repayment, utilization, all those things will be mentioned in this type of agreements. So these are all the various types of transaction documents we have: term sheet, subscription agreements, then we have deed of adherence, then we have addendum to the agreement or amendment to the agreements, then we have amended and restated articles, which are nothing but the drawing of provisions from these agreements. Then we have separately intercorporate loan document in case of ICDs. Then what are the different terms used in the funding agreements? We have seen company can enter term sheet, company can enter shareholders agreement, share subscription agreement. But these agreements are not general, not the regular agreements. These agreements are always tailor-made. These agreements will be, with multiple versions of these agreements. At least I have seen, I worked on transactions wherein we have worked on at least 20-25 versions of the same agreement, where different parties are involved, different investors will have different concern, promoters and the existing shareholders will have different concerns. So it is important for us to understand what are the different terms generally used in these funding agreements, how it will impact our funding process, what it means, and how we should arrive at the conclusion. So to start with, one of the important aspects in the funding agreement is definitions. What is this definition? Definitions are not the general words. So throughout the agreement, there could be a reference to something called say capital. We cannot derive the general answer of capital, general meaning of capital. We have to see what is defined in the agreement. So the word capital has the meaning as defined in that agreement. Throughout the agreement, it has to be read in that context. So it becomes important for the draftman to observe the provisions of the agreement with respect to definition to understand the meaning of any particular word. So how these definitions are given either as a separate section, there will be separate clause for definitions, or within the agreement itself. More specifically, the defined words are generally used in the form of capitalized words. For example, the definition can be explained in this way. Say for example, business day. There is a definition in the definition clause. The business day shall mean other than Sunday or Saturday on which scheduled commercial banks are open for business in Karnataka, India. This is one classic example of a definition. So definition clause will be there. In that, he will mention business day means so and so, so and so, which means for the purpose of that agreement, throughout the agreement, you have to assume wherever the word business agreement is mentioned, the business agreement means as defined in the agreement. It is not necessary that the definition should give the complete meaning itself. Another example of definition is claims. Say, for example, claim shall have the meaning as set forth in clause so and so. So he is not giving what is claimed, but he is referring to a particular clause. So whatever the meaning that comes in so and so clause is nothing but claims. So when we say the definition of claim is not defined in the agreement directly, but it is defined in the agreement indirectly. This is another way of defining the term in the funding agreement. There can be another way also. Within the agreement itself, there can be a definition. Not necessarily in the definition section. The other parts of the body of the agreement can also give you the definition. For example, we have investors here to agree to invest blah 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 blah, hereinafter referred as subscription shares. He has mentioned in the bracket called as hereinafter referred as subscription share, which means throughout the agreement, wherever the word subscription shares are mentioned, that means those 1 lakh equity shares of rupees 10 each. So he has defined hereinafter referred as subscription share. Again, it is not mandatory to specifically say hereinafter referred as subscription share. In the next example, he said designated bank account is defined. Investment amount shall be remitted in the separate bank account designated by the company for this purpose. Bracket, he has just mentioned designated bank account. So these are all the various means. As I mentioned in the beginning, transaction documents are always tailor-made. There is nothing called standard. So the definition can be either in the form of specific clause, or it can be embedded in the within the clause in the specific meaning of the clauses, or it can be referred to some other clause, or in one or the other way it can be referred. But whenever it is referred, it is generally referred in the form of capitalized words. Next important aspect that we have to see is preemptive rights. Every agreement, funding related agreement, will generally have the preemptive rights. What do you mean by this preemptive rights? Preemptive rights are rights to invest in or purchase the further securities issued by the company. These rights are given to the investors. So what it means, if I'm an investor who has invested certain money into the company and I have 5% stake in the company, I would probably want to protect my shareholding in the company. So whenever company proposes to issue further securities, it has to first offer it to me, giving me right to further invest into the company so that I maintain my shareholding. This is called as preemptive right. Another important aspects of funding agreement is condition precedent and condition subsequent, point 3 and point 4 here. What is this condition precedent and condition subsequent? CPCS matters in general known as. Condition precedents are those matters which are required to be adhered by the company prior to obtaining the investment. Generally, these can be statutory item or it can be non-statutory item also. For example, company should pass shareholders resolution before they take the investment from investor is a statutory item, because provisions of section 62 of the Companies Act says before company issue further securities, it has to obtain the approval from the existing shareholders. This is a statutory item. There can be non-statutory item also. For example, company has to obtain so and so license before the investor makes an investment. So company will have to make an application, obtain so and so license, then give the satisfaction letter to the investor, post which the investor will invest. So these are all the conditions called a condition precedent. Generally, these conditions are derived in the agreement, drafted in the agreement based on the findings out of due diligence. So before the investment, more specifically after the term sheet, but before the agreement, investors will generally do an investment due diligence into the company, whether the company has done any default in the tax laws or corporate laws, or there are any commercial contract obligations. So all these due diligence will be done by the investors before they make a final decision of investing into the company. And once the entire due diligence process is completed, the investors will come up with a list of points which they want company to comply before they can make the investment. Say, for example, if company has done certain defaults in complying with the provisions of Companies Act, investors may ask the company to go for compounding. This could be one of the condition precedent. Similarly, we also have condition subsequent. What is this condition subsequent? Things to be done after the receipt of investment. So it's kind of a post facto related points. Again, this could be statutory and non-statutory items. Statutory items could be issue of share certificates, filing of necessary returns before the ROC, payment of stamp duties and things like that. Non-statutory items could be within 3 months from the investment, company should appoint a CFO, company should open so and so branch, company should make so and so application. All this could be non-statutory items. Again, these points could also be driven from the due diligence points. Due diligence might have certain observations. The process of DD might have certain observations which company should complete within so and so period. So the investor might say, after my investment, within so and so period, the company has to complete this. So these condition subsequents are time bound generally. Whenever he gives condition subsequents will have to be completed within specific time period, say within 15 days, within 1 month, 3 months, 1 year, whatever it may be. So these are all the different aspects of condition precedent and condition subsequent. Moving on, the another important term used in the funding agreement is called as closing. What is this closing? Closing is an investment event. On this day, on the closing date, the investor will pump in the money into the company. Generally, on this day, the issue of title documents, be it share certificate, debenture certificate, whatever it may be, will be issued, and articles of the company will be altered. So all these three and many more, as investor may find it correct and useful, will be included in the closing. And if it is happening on multiple different dates, the closing is assumed to be taken on which the last activity is completed. So this is generally called as closing. Another important term used in the funding agreement is covenants and undertakings. It's kind of commitment by the founders, commitment by the promoters about the future of the company. Company will adhere to the provisions of tax laws. Company will adhere to the accounting practices, proper accounting practices. Company will not participate in the bribery events. Company will do 1, 2, 3, 4, 5 aspects. All these things are covenants and undertakings. Now, these covenants and undertakings are generally given by the founders, promoters, along with the company to the investors as part of the investment agreement, which can create a lot of comfort to the investors while making the investment. Like we have covenants and undertakings for the future, we also have something called reps and warranties or representation and warranties in respect of the past activities of the company. Though investor has done certain amount of due diligence, he will be doing the due diligence of those aspects which are provided to him. There could be a possibility where company is concealing certain events, certain information from the potential investor. The investors generally want to cover those aspects through the reps and warranties clause in the agreement. So these terms, reps and warranties, will say about past about the company, what has happened in the company so far. The founders, the promoters will have to give commitments for representation warranties that the company has always done the business in a right manner. They have paid all the taxes. There are no litigations against the company. There can be any number of representation warranties that the promoters are asked to give. It is extremely important for one to understand, read each and every word mentioned in the reps and warranties of the funding agreement, because if there is any misstatement in the funding agreement with respect to reps and warranties, generally this will be linked to the event of default. What is event of default, we will again see in the subsequent slide. But in general, event of default is where there are certain terms of the agreement is breached, and investors will generally have right to get back their investment, take back their investment from the company along with certain X of return. So reps and warranties are one of the very important critical aspects of the funding agreement, where one has to go through line by line, word by word, and see whether everything that is mentioned in the agreement are true and correct or not. Next important term used in the funding agreement is called as ESOP pool or ESOP scheme. Whenever investor comes and invest in the company, the agreement between the company founders and the investors will be that he will invest a certain amount of money for a certain amount of stake. Let's say, for example, I am investing in a company, an amount of 10 crore for a 10% equity. When I say I will get 10% equity in the company, that means generally the amount of investment on a fully diluted basis. So what is fully diluted basis? Considering all the conversions possible, including the ESOP point. So there may not be any ESOP holders today, but investors want to protect their shareholding by already reserving an ESOP pool. So these are all not number of shares that are allotted to any employee. No, but they create 5% pool, 10% pool, certain number of shares they will reserve for the ESOP, so that tomorrow, even if company issues these shares to employees, investors will continue to maintain their shareholding in the company. So ESOP pool is a fictitious number, but the moment when ESOP pool is created in the transaction document, even in our board's report and in the notes to account, we have to be very cautious whether the company has created any ESOP scheme or not, and giving disclosure about those ESOP related particulars. Why I say this is one of the critical aspect or important term used in the funding agreement is, whenever we do accounting, whenever we do auditing of the books of the company, we may have to specifically ask the ESOP related points, because this is a non-financial item. If there is an investment comes to the company, even if company is not disclosing that fact, but by looking into the bank statement of the company, one can understand that there is a money that is coming into the company, which has to take either the color of debt or investment. But in case of ESOP, as I already mentioned, ESOP is a fictitious number. There would be probably no event of any bank entries in which the employee has exercised the shares or anything, but company has issued the ESOP to an employee. The moment when company has issued the ESOP, it is very important for the accountant, the auditors to look into that matter and recognize the ESOP expense into the books, failing which the company will lose the benefit of taxation. And also, it becomes statutorily important for us to disclose certain mandatory information about the ESOP the moment when the company has the ESOP scheme and related aspects. So the funding agreement, one of the important item is ESOP pool. So if our funding agreement has got the ESOP pool, it also should trigger the necessary compliance under the board's report and the notes to account prepared by the company. We already discussed about the fully diluted basis. Another important term in the transaction document is anti-dilution protection. What is this anti-dilution protection? There are two types of anti-dilution protection. Generally, these anti-dilution protections will help the investor to protect his investment whenever there is a down round investment. What is this down round investment is? Let's assume I am an investor and I have invested in the company at a valuation of 50 crores. I have invested 5 crores at 50 crores valuation. Typically, I got 10% in the company. But in this scenario, what happens is the company subsequently is not performing well. Its business is not going the way how promoters have thought. And company is now required to issue further securities, raise further capital, say for 25 crores of valuation. Don't you think it is an harm to the earlier investor? Because earlier investor has invested at 50 crores valuation, whereas the subsequent investor is investing at a half of that price. This is called as down round issuance, where the next round of issuance is done at a price which is lesser than the present issuance. In this scenario, generally the investors want to protect their interest and introduce something called anti-dilution protection clauses. There are two types of anti-dilution protection clauses generally accepted. One is called as full ratchet anti-dilution protection. Another one is called as weighted average anti-dilution. What is full ratchet? Full ratchet anti-dilution is a conversion price of the existing preferred shares is adjusted to the downward price. Basically, for example, if the issue of preference share is done at rupees 50, whereas the subsequent round of investment is done at rupees 20, the conversion of that preference shares into equity will happen as if the investment is done at rupees 20. This is called as full ratchet anti-dilution. Is it a good practice to accept full ratchet, or should anyone go for weighted average? To answer this query, let us first try to understand what is weighted average anti-dilution. Weighted average anti-dilution is also a protection given to the investor, wherein the price of the subsequent investment is considered for adjusting the conversion price of the existing securities, but there will be weightage given to the amount of investment raised in the subsequent fund, number of securities that is issued, and the price differences. Now, compared to full ratchet anti-dilution, weighted average anti-dilutions are less harm to the promoters, founders. Because in case of full ratchet anti-dilution, even if company issues one share at a price of 20, the entire shares issued in the previous round is eligible to be converted at the same price. Whereas in case of anti-dilution, there would be hardly any difference. So these two are the generally accepted, anti-dilution terms. Even in the open capital market, also the weighted average anti-dilution is widely accepted by both investors as well as founders, promoters, assuming and considering that the acceptance of weighted average is the fair acceptance of anti-dilution protection available to the founders, available to the investors. Moving on, the exit terms. One of the interesting aspect for the investor and most negotiated terms in the funding agreement is exit terms. Any investor who has put in the money into the company's business would want to take an exit, if not today, one day in the future. How do he take the exit from the company? what are the different modes available for him to take exit from the company is called as exit terms or exit provision. Generally, the exit terms will contain the provisions with respect to IPO. IPO is ultimate dream of every startups, every founder, promoter to reach. So the place where everyone wants to be basically. If not IPO, if there is an IPO, company is offering the shares to the public, and there can be offer for sale also, where investor will take an exit and sell his shares to public at large and make money out of it. But if there is no IPO, not every company can get to the stage of IPO, right? So if there is no IPO, then what is the next available exit opportunity for the investor? Strategic sale. Strategic sale can be of sale of shares or sale of business of the company. So it is nothing but basically sale of the entire entity. Either the company and promoters will find a potential acquirer who is ready to acquire the shares of the company and thereby give exit to the shareholder or the investor, or the promoters and founders and company will sell the business of the company, make money out of it, and then distribute to the investors. So this is one another way where investor can take an exit. The third category is called as buyback of shares. This is another exit available to the investor. If company is performing well, company can do selective buyback. What is the selective buyback? Selective buyback is where the buyback offer is given to all the shareholders, but promoters and other founders of the shareholders will not participate. Only investors will participate, wherein the company will end up with buying the shares of investors back and giving back their investment at certain X of return. This is another exit term generally used in the funding agreement. However, buyback is not possible for every company because company will have to adhere to certain statutory provisions with respect to buyback, more specifically with respect to the level of reserves and profits that the company already has got. If IPO is not working out, strategic sale is not working out, buyback is not working out, then there can be another way where third party sale can provide the exit to the investors. What is this third party sale? Third party sale is where one will find an acquirer, where the acquirer will buy the shares of investor. Whether this acquirer will be found by the promoters or the investor, that is a different matter. So promoters or the company will have to find an exit to the investor. So what they do is, instead of doing IPO, because IPO is not possible, strategic sale is not possible, buyback is also not possible, they may go to another investor and say, hey, there is an investor who is ready to sell the shares in our company. Will you be interested to buy the same? Arranging this is also called as third party sale and one of the exit term under the funding agreement. If none of this is happening, then company is not performing well. If company is performing well, and any of this exit is possible. If none of this is possible, then the last way of exit for the investor is liquidation. And in that liquidation preference, this is something like minimum payout to the investor that is agreed in the agreement. So these are all the different terms that are generally used in the funding agreement with respect to exit. Moving on, the investor protection matters. Some of the terms used for investor right protections are tag along rights. What is this tag along right is? Tag along right is also known as co-sale right, where the investor will have right to sell with majority at the same terms as the majority is selling. Let's assume the investor has 10% stake in the company, and the founders, promoters have 90% stake in the company, and founders are selling their shares to a potential acquirer and taking exit from the company. At this stage, if investor has a tag along right, he can compel the acquirer to also purchase his shares, because investor has got a tag right. He can tag his shares along with the founder's right. So this tag along or co-sale rights are generally available in every funding agreement which are a kind of non-negotiable points from the investors. No investors would want to enter a funding agreement without the tag along rights. Similarly, there is something called drag along rights. While we have understood what is tag along is a place where investor can sell his shares along with the founders, along with the promoters, or along with the other majority shareholders. What do you mean by drag along right? Drag along rights are one of the strongest and wildest tool available to the investors to take an exit from the company. As we have seen in the previous slide, either company should give an IPO, give an exit by way of an IPO, or strategic sale, or buyback, or third party sale. Let's assume none of this is happening and investor want to take an exit. Investor, he himself is finding another buyer who is ready to acquire his shares. But you may also assume and observe one more point here. Investors will have always minority stake in the company, say 10%, 15%. And when he proposes to sell the same to potential acquirer, that acquirer is not interested to just buy just 10%, 15%. He might be interested to buy say 50% in the company, 75% in the company, so that he controls the majority of the company. But to offer 75% or 50%, investors do not have so much of shares. So the drag along concepts, drag along rights of investors will help the investor to take an exit by offering his shares along with the dragged shares of the founder. So when potential acquirer says, hey, I want at least 51% stake in the company, then only I will buy the shares. Then if I have 10%, I will make sure that I will also drag the founders, drag the promoters, and compel them to offer the shares to that potential acquirer so that I get an exit from the company. In this, of course, even the dragged shareholder will also get the same benefit as to what I am getting, if whether it is per share price or otherwise. But they have no other option but to sell the shares along with me. So this is one of the very strong, as I mentioned, wildest tool available to the investors for protecting their exit from the company. While tag along and drag along rights are exit related points that investors want to again protect in the funding agreements, there are terms used like rights of first refusal and rights of first offer. What do you mean by this rights of first refusal and rights of first offer? Rights of first refusal, or it is also in short called as ROFR, gives the right holder to choose to buy the shares from the company before the shares are offered to outside party. Similarly, even rights of first offer is also always a right, that the seller should first offer. What is the difference between rights of first refusal and rights of first offer here? In case of rights of first refusal, the seller has to communicate the price, the terms of sale to the ROFR holder, the investor, upfront. Whereas in case of ROFO, rights of first offer, the seller will only communicate the intention of selling. He will not communicate anything called price or the terms of sale, the valuation, nothing. So if you observe both the rights of first refusal as well as rights of first offer, the result ultimately remains same. However, rights of first refusal is always more stronger, more stricter than rights of first offer. Moving on, another important term used in the funding agreement is non-compete and non-solicit provisions. When investor comes and invests in the company, he is primarily investing on the promoter, on the founder, or the idea behind them. So more specifically in the startup ecosystem, the founders, the promoters will come up with an idea which are attractive to the investor, and they are ready to invest in the company, but they come up with a non-compete clause. What is this non-compete is? They put a condition on the promoter, on the founder, that in the event if I invest in the company, the founder should continue with the company for so and so period, and even after selling his shares in the company, he cannot start the similar business. He cannot join hands with the competitors. That's what non-compete and non-solicit clause. Not to do similar business, No moonlighting provisions. What is this moonlighting restrictions? Sounds so romantic, in fact, but it is not so romantic. Moonlighting is the restrictions placed on the founders, where while they are founders of this company, working for this company, whether or not the other business that they are running is competing or not, they should not run the other businesses. For example, a company wherein a software company wherein the promoter is a software engineer cannot run a pawn shop. This could be a moonlighting restriction. Then another important term used in the funding agreement is affirmative voting or reserved matters. As I already mentioned in the first half of our discussion, reserved matters are those matters which require affirmative voting, the express consent of investors. These express consents are mandatory to deal with any of those items which are mentioned as reserved matters. Why this is included in the funding agreement, and also this is also used in the included in the restricted and amended articles. Why this is one of the important term in the funding related agreements? As I already mentioned, investor may invest huge amount of money into the company, but actually end up with getting a small stake, maybe 5%, 10%. Whereas the founders, the promoters who have started the business, started the idea, might not have invested so much of money, but still control majority of the stake in the company. And all of us, we know the way how company takes decision is based on the will and wish of the majority. So to protect the interest of minority, the investors may come up with a list of reserved matters, the critical aspects where the investors will have right to say yes or no, and without the consent of the investors, the promoters, though having majority, cannot deal in those resolutions. Those items are called as affirmative voting matters or reserved matters. Then we have another important term called lock-in provisions. Lock-in provisions are those provisions which locks the promoter so that he will not shop outside. What do you mean by locking of promoter shares here? When an investor, we already discussed it, when an investor is investing into the company, the huge amount is invested not just on the company, but also on the idea of promoter. But if promoter himself takes an exit from the company, who will run the company? Who is going to build that idea, right? So generally the investor, whenever they come with a investment agreement, the important term that they generally put in the agreement is lock-in provision, wherein they say till the product is developed or till company has achieved so and so target, the shares of promoters are locked in. Meaning the shares cannot be dealt, the promoter cannot sell, or transfer the shares to an outsider. The investor may also come up with a vesting schedule. Vesting schedule is over a period of time or upon completing so and so milestone, certain percentage of promoter shares will be vested. Say out of 100% of shares that is locked in, 20% is vested on first year, 20% is vested on second year, like this. Then we also have another important term called event of default. While discussing the reps and warranties, I mentioned we have to be very cautious and be clear with what we write in reps and warranties, because if there is any misstatement in the reps and warranties, that may lead into event of default. What is this event of default? Event of default is nothing but breach of contract, where investor has defined event of default, which says or which makes investor to back off from the investment or take back his entire investment. It is not just the take back of investment. Investors will also have many times, the funding agreement will contain the provisions that investors will have right to choose the directors. He will have the complete control of the management of the affairs of the company, and also have the complete business decision powers. So event of default is one of the important term to be negotiated, to be looked into while drafting the funding agreements. Then another important aspects of funding agreement is dispute resolution mechanism. When we say agreement, agreement is agreement of parties, which might end up with become disagreement tomorrow. So there can be an argument, there can be dispute between the parties, which has to be resolved. And the provisions of Indian civil codes are very clear in terms of how dispute is to be addressed. We have arbitration and conciliation acts, which gives preference of mutual understanding of resolution of disputes. Generally, the funding agreement contain the provisions with respect to arbitration, including how to select the arbitrator, where the arbitration venue should be, how arbitration proceedings should be started, within what period the arbitrator has to resolve the dispute and give his verdict. So all these points are called as dispute resolution mechanism. Both the funding agreement as well as the term sheets will have the points relating to dispute resolutions, and generally these terms are binding on the parties and can be also adhered in the court of law. Next important term used in the funding agreement is I can call it as miscellaneous terms, called indemnification of losses. What is this indemnification of loss? We have seen reps and warranties, we have seen event of default, but these two are not sufficient for investor to protect his interest in the company. What if company has suffered a huge loss because of some misstatement by the founders, and even the investor has lost his money? So in such events, such incidents, investors generally come up with the indemnification clauses, wherein they will specify that in the event if there is any misstatement in the reps and warranties, if there is an event of default, investors should be indemnified personally by the founders so that their investment is protected. And basically this is an event where make the loss good. Whatever the loss suffered by the investors should be made good by the founders, promoters who are at default. Then we have another concept called disclosure schedule. What is this disclosure schedule? We have seen reps and warranties, and we have covenants and undertakings. All these are part of the agreement. We would have written 100 points in that, like company has done this, company has done that, company is compliant in all the tax laws. There may be a possibility. Let's assume when I say company is completely compliant with the tax laws, there could be an event where in one particular month company has delayed the payment of TDS or filing of TDS returns. That is still a non-compliance under the income tax law. But under the agreement, we have already mentioned that the company is compliant with all the provisions applicable to company under the tax laws. There is no default, whereas there is actually a default. So if company has already given such type of reps and warranties, there can be a separate schedule where company can give a disclosure letter stating what is not correct in their company. And this will save the company from the doctrine of constructive notice, wherein promoters can always take a umbrella of disclosure and save themselves from the potential event of default in the future. Then there is a concept called standstill provisions. Standstill provisions are a term which says that no action should be taken by the company till the further negotiation. Generally, the standstill provisions are applicable between the term sheet date and the investment. So company cannot take any new related party transactions, company cannot enter into new agreements which concerns or benefits the promoters. So all these points are generally covered in the standstill provisions. So these are all the various terms used in the funding agreement, which has got its own meaning. There is one Latin maxim, expressio unis est exclusio alterius. What do you mean by this? What is not expressly expressed cannot be implied. Why I am drawing this particular concept of our Latin maxim here is, there is nothing in the entire funding agreement which is general in nature. If it is there, it is there. If it is not there, it is not there at all. One cannot assume the intention of the draftman in the agreement, be it a definition, be it a term of the agreement, be it the way how the rights and obligations are mentioned. Everything has to be clearly mentioned. If it is not mentioned, it is not there at all. One cannot assume that the meaning of so and so clause is so and so. So while drafting the funding agreement, while drafting the investment agreements, one has to be very careful in mentioning each word, be it in terms of refs and warranties, be it in terms of rights of the investor, be it in terms of disclosure letter. One has to be very clear and very any point that is important for investor and promoter to discuss, negotiate, that has to be negotiated and properly put into the agreement, because once it goes to the agreement, it becomes law for those promoters, and hence it is very important for anyone to know the meaning of these terms used in the agreement, the impact of that, how it will be impacting in the future, and then draft the same. Now let us try to understand the accounting and audit requirements of these funding instruments and funding agreements. So one of the important aspect that we have to observe during our accounting and audit process is whether the company has issued any funding instruments during the year under review, and if the company has specifically issued preference shares and debentures, whether the company is making necessary arrangements for recognizing the dividend and interests. As the point before your screen says, interest rates on debentures are one of the important point. Even if it is nominal rate, even if it is 0.001%, that interest has to be recognized. Whether or not you pay the interest as a company, the interest has to be recognized. The moment when the interest is recognized, the TDS provisions are applicable. The TDS has to be deducted on that and accordingly paid to the income tax authorities. In case if interest is not paid but still recognized, that becomes a deductible expense in the hands of the company. Thereby, company can also claim the tax benefits. But in case if the company has missed to do any of these and subsequently notice in the next year, we cannot claim the same because that becomes a prior period experience. Prior period expenses. Next important item is, as I was mentioning, dividend on preference shares. Like how we have interest on the debentures, even though it is nominal, it has to be paid. In case of preference shares, we have to observe whether the dividend is cumulative dividend or non-cumulative dividend. In case if it is non-cumulative dividend, the dividend has to be paid in the same year. In case if it is cumulative dividend, company has the flexibility of deferring the payment of dividend at a later date. Once the dividend is declared, the distribution compliance will have to be adhered. Company has to open a separate bank account, deposit the dividend amount into that separate bank account. Even if it is nominal amount, let's assume the dividend amount is 100 rupee. Even with that 100 rupee, you have to open a separate bank account, deposit into separate bank account, and then from there you have to pay to the preference shareholders. Of course, dividend tax is abolished now, but still the tax on dividend is now applicable in the individual hands, and company will have to take necessary actions to comply with the tax provisions that are applicable. Moving on, another aspect, ICD requirements. Whenever company has given money through ICD, intercorporate deposits, it is mandatory for company to charge the interest which are equal to or greater than the closest tenure of the government securities. So if government securities have a yield rate of 8%, the company cannot give loan to another company at 5% interest rate. It has to be at least of 8%. The provisions of section 186 subsection 7 is very clear on that. The company cannot give interest-free loan to another company. It has to be with minimum interest rate as specified for government securities. And the disclosures of purpose of loan in the financial statements. Though the company has given the money to another company, for what purpose the other company is utilizing that money is to be recorded, is to be disclosed in the financial statements of the lender. The lender has to disclose in its financial statements as to for what purpose borrower is using it. See the requirement of disclosure here. So this is one of the important aspect that the company will have to adhere in case company has already issued through ICD. Then we have ESOP. As I mentioned, whenever investor is coming, investor want to always come on a fully diluted basis. So he want to protect his shareholding in the company. So he would want the company to implement the ESOP before he comes and invests into the company. The moment when the company has implemented the ESOP, the accounting and auditing requirements will again shoot up. As I was mentioning, this is a pool, this is a non-financial transaction. So we might not see it in the bank statement. So we'll have to specifically ask the company whether they have implemented the ESOP or not. This should be part of the audit checklist. And if so, if they have implemented the ESOP, the provisions with respect to ESOP expenditure, the grant of options, the expenditure incurred in granting those options, the difference between the exercise price and the grant price, all those things have to be recognized in the books of the company and thereby allow the company to claim the tax benefits. Then again, next important aspect is valuation report. As and when there is a issue of securities, be it debenture, be it preference shares, even in case of issue of ESOPs to an employee, company is required to obtain valuations. And these valuations are required at the time of issue of securities. And not just at the time of issue, the valuation report is also required to be taken at the time of conversion of securities. So both at the time of issue as well as at the time of conversion, company is required to obtain the valuation reports. And when we say valuation report has to be obtained from a registered valuer. There are questions in the among the professionals as to should the company require to take a valuation report at the time of issue of convertible securities? Because there is a provision which says the valuation can be done either at the time of issue of securities or at the time of conversion. No, there is a specific provision. The valuation of the equity can be done at the time of issue or at the time of conversion. However, valuation of the security being issued, that is either debenture or preference, have to be done by the registered valuer at the time of issue. So we require the valuation report both at the time of issue of securities as well as conversion of securities. And these valuation reports are important for us to obtain also from the merchant banker. So registered value or valuation report is required for the compliance of Companies Act requirement, whereas for the purpose of income tax requirement, for the purpose of justification of premium under section 56 subsection 2 or justification under section 68 of the IT Act, the valuation report has to be obtained from the merchant bankers. So these are all the points with respect to accounting and audit requirements that the company has to adhere from the valuation point of view. Moving on, another important aspect of the accounting and auditing requirement, in case if the company has raised funds during the financial year, is disclosure of shareholding. We all know the balance sheet will have the disclosure of shareholding. We have 5% disclosure of promoter holding in the company and all. This is part of the notes to account. Generally, what we do, we carry the same number of shares. There might be a chance that since the company has issued further capital to the new investor, the percentage of ownership of the promoters, the 5% holders, have come down. That also one has to observe and make a necessary changes in the financial statements. Potential subsidiary, this is one of the another big area to observe and if required adhere to the relevant provision. The investment agreements might contain the provisions with respect to appointment of board of directors. And if the investors are controlling majority of the board of directors, let's say, for example, one company has invested in the another company, and that another company has got, the investing company has got the existing board of 2 members. And as per the investment agreement, the investor company has a right to appoint 3 members in the board. which means that investor company has right to control the subsidiary, right to control the investee company. And the definition of subsidiary, if you go, we all again go by the formal definition, which says, hey, if one company owns more than 50% shares in the another company, that becomes a subsidiary. Yes, that is correct. But in addition to that, we also have company can become a subsidiary of another company if its board is being controlled by that another company. So there are two criteria. One is by way of shareholding, another by way of board control. So if the investment agreement provides for appointment of majority of the directors on the board of the subsidiary company, the investee company, that investee company becomes subsidiary company of the investor. Though, as far as the shareholding is concerned, is less than 20%, less than 10%, less than 5%. So we have to observe whether the company after the investment becomes subsidiary of another company or what. And in case if it becomes a subsidiary company, the moment when the holding and subsidiary relationship is established, though company is a small company or a startup company, but it comes out of the definition of small company, and hence cash flow statements are applicable and consolidated financial statements are applicable. So holding company and subsidiary company, holding company will have to consolidate the accounts, so investor will have to consolidate the accounts, and subsidiary company will have to prepare the cash flow statement, though it from all other perspective of the law is a small company and exempted from preparing the cash flow statement. Next important item is utilization of funds. The standard disclosures in the audit report, CARO, also require us to disclose about the utilization of funds raised by the company. In case if company has raised funds, but has used it for the purposes other than what is mentioned in the offer document or the board resolution and the explanatory statements along with the agreements, the auditor will have to comment on utilization of funds as well. So again, it becomes important for the draftman while drafting the agreement for what purpose the investment should be utilized. That has to be clearly, elaborately defined in consultation with the company. And also PS for the offer document will also should disclose the purpose of raising the funds. And the auditor will have to comment whether the company has used those funds for the purpose for which the same is raised or not. So this is another important aspect that accounting and auditing requirement we have to observe. Then we have limits on spending. While the investor has made an investment through the condition subsequent or other provisions, investors might have controlled the utilization of funds. They might have said, okay, on capex, only so much is required to be spent. On OPEX, so much is required to be spent. On advertising, so much. On managerial remuneration, so much. So they would have, in the agreement, they would have mentioned a restriction. So being auditors, being the persons who are preparing the accounts, we have to be very cautious and observant of the provisions of the investment agreement as well. So if company has taken an investment, the first point in our checklist should come is whether company has investment agreement. If yes, what is that investment agreement says about utilization of funds? Is there any restriction on that? Private companies are not required to adhere to the provisions of section 196 and 197, which speaks about managerial remuneration and restrictions. But investment agreement can restrict this. So we have to observe the provisions of investment agreements with respect to limits on spending. Then we have creation of DRR and deposits. In case of redeemable debentures issued by the company, it is important for the company to create 10% of value out of profits in the form of DRR, debenture redemption reserve. And company should have at least 15% of debentures that are getting matured in the deposit in the scheduled bank. So these are all the provisions, statutory provisions, in case if the company has issued redeemable debentures. Creation of DRR and further deposit into a separate bank account is not applicable in case if company has issued compulsorily convertible debentures and all, because there is no redemption, hence no DRR requirement. But in case redeemable debentures are being issued, the company has to create DRR accordingly. Yes, so these are all various provisions, various points that one has to observe while advising the company on funding transactions, whether in terms of choosing the instrument which can be issued for raising funds or while drafting the funding related agreements. Now the floor is open for questions. We have one question from Mr. Prashant. Term of exit, what is the difference between strategic sale and third party sale? Yes, good question. Strategic sale is, if I can just go to the same slide, strategic sale are generally sale of the entire company, either in terms of the complete shareholding or complete business. So in case of strategic sale, what happens is the investor wish to take an exit and promoters and investor together sell the company to some new acquirer, or it can be merged into another company. Either they will sell the company, when I mean sell the company, selling their shares, or they may not sell the shares that they have in the company, but sell the business under this slump sale model. So this is called as strategic sale, whereas third party sale is sale of shares exclusively by the investor to the potential acquirer. In case of third party sale, the existing promoter will not participate. That is the difference between the strategic sale and third party sale. And more specifically, in case of third party sale, it is only of sale of shares owned by the investor, whereas in case of strategic sale, it could be sale of share by the entire shareholding, or it can be sale of business as a slump sale. Then next, we have, if there is a breach of any clauses of the investment agreement, should it be disclosed in the notes? And do as an auditor, should it be mentioned in the audit report? No, disclosure with respect to breach of the clauses of the agreement is not required, because the agreement may contain 100 other provisions which might not be audit point. But breach of the agreement, say with respect to utilization of funds, definitely one has to qualify, because this is as good as violation of the articles also. Generally, when there is a provision with respect to governing any of these in the agreement, these points will also be brought into the agreement, sorry, articles of association, by amending and restating it. That is one of the point previously we have seen. So that the provisions of agreements are now also part of the articles, which means if company is not adhering to those articles, it becomes an ultra virus, and hence one has to comment on that. There has to be a disclosure. But the breach of agreement could be many other things also, like say for example information rights. Company will have to provide MIS to the investors on a quarterly basis, and company has breached that. These breaches need not be mentioned in the disclosed in the audit report or notes, because these are not audit points, or not relating to financial in nature. Hope I have answered that. And any other questions?
Sir, there is one question on the chart, sir. Pradeep Badi has asked this question. Whether valuation is required for issuance of CCD? First question he is asking, sir. Second question, what is the timeline to file the CHG1 for issuance of non-convertible secured debentures? And third question he is asking, from the iSafe model, can't we issue equity?
I'll take one by one, because these three are
yes, sir.
Different questions. So whether valuation report is required for issuance of CCD? Yes, valuation report is required for issuance of CCDs as well. As I was mentioning while presenting in the presenting the screen also, there are two school of thoughts among the professionals that while issuing CCD, valuation report is not required. I'll now specifically draw the attention to a particular clause. The private placement regulation says about the valuation. There is a rule 13, 1G and rule 13 1H of the private placement regulation, which says that valuation report is required at the time of either at the time of issue of convertible securities or at the time of conversion. This is what rule H says. But underlying point there one has to observe is, if you see the provisions, what it says is the value of equity is required to be valued, is required to be ascertained either at the time of issuance of CCD or at the time of conversion of CCD. Fine. But there is a clause which is a clause G before this clause H, which says the price of the shares or securities being issued. So there is no question of valuation of equity or valuation of the entity here. Clause G, he says valuation of the security being issued. What security we are issuing? If you are issuing CCD, valuation of the CCD has to be obtained, has to be arrived by the registered valuer. Clause H speaks about value of the resultant shares. Resultant shares are shares after the conversion. Clause G and clause H in the relevant regulations are two different things. So there is a big confusion among the professional. Should the valuation report be obtained for valuation of CCD at the time of issuance of CCD or not? Yes, it has to be obtained under clause G, but not under clause H. Next question is, what is the timeline to file this CHG1 for issuance of non-convertible secured debentures? In fact, we will not file CHG1, we will file CHG9 in such situation for issuance of secured debentures. I will have to confirm the time frame again. If I'm not wrong, it is 30 days, but if there are anything else, I will look into that. But it is not CHG1 we will file. CHG1 is filed for creation of charges in case of general loans, whereas in case of debentures, the form CHG9 is filed. From the ISAFE model, can we issue equity? Not possible to issue equity. As I was mentioning, SAFE is a concept globally available except in India. Simple agreement for future equity. We cannot just enter an agreement and take money and do the business. In many other countries, like the popular jurisdictions like state of Delaware in USA and Singapore and all, there is a concept called SAFE agreements, where company can just take the money by entering an agreement and give the terms of conversion and thereby issuing no instrument at all. There is only agreement. Whereas in India, we cannot, there is no concept called SAFE. However, startup ecosystem has come up with something called iSafe, making of that SAFE concept that is globally available. iSafe is a terminology used for CCPS or debenture. There is nothing called iSafe separately. There is no instrument called iSafe. iSafe is just a fictitious nomenclature, I can call it as, to make the global investor familiar with the Indian scenario. That is the only intention of iSafe. iSafe will have to take the color of CCPS or debentures. So iSafe will always be either CCPS or debentures, but not equity. Okay, we have one more question on the Q&A. What should be the time gap between two valuations? Very recent notification from the RBI and Companies Act with respect to valuation report, which speaks about the valuation report that can be used is a maximum of 90 days. This is what the valuation rule says. But it says it is not even validity of the valuation report. It is the validity of utilization of valuation report, because valuation report, as we all know, is generated on a valuation day. We will consider something called a valuation date, and the valuer will come up with whatever the value on that valuation date. The valuation might change even the very next day itself. Let's assume one is valuing, say, the cab aggregator, take Uber, Ola, whatever it may be, and we say the company is valued for $1 billion. And if tomorrow government comes up with a regulation and says, hey, the private sector cannot run cab business, it becomes a government monopoly, and they pass law in the parliament, and the valuation of Ola, Uber becomes zero next day. there cannot be any validity period for the valuation report. There could be validity period for utilizing that valuation report for the compliance purpose. This is what I could say. From this angle, what should be the time gap between two valuation? There is no time gap, minimum or maximum. Having said that, if there is a significant difference between the price 1 and price 2, there has to be a proper justification. There cannot be two prices on the same day or relevant dates unless there is an extraordinary item. So the question to specifically answer what should be the time gap between two valuation, there is no specific timeline time gap required. The valuation, as I was mentioning, can change overnight also. Valuation can change with the money coming in. If somebody is investing 5 crores, the entity valuation may be different. Somebody who is coming up with 500 crores investment, the entity valuation can be different, because what you can do with 5 crores and what you can do with 500 crores, the projections will change entirely. And hence, what should be the time gap between two valuations? Answer is infinity or no gap at all. Right. I think I am almost dot to 6 o'clock. Happy to take any questions. Otherwise,
Yes, sir. Yeah, we can
thanks for
close, sir.
giving this opportunity.
Yeah. Thank you, sir. You have explained in detail about various options of funding arrangements, special terms in funding agreements, and accounting or auditing requirements with respect to funding. Finally, I would like to thank all the attendees for being a part of today's webinar. Before I conclude, I would like to bring to the notice of attendees that KSSCA has planned for many other sessions for the future, and all such details are available on our portal. Participants shall be able to refer today's presentation at KSSCA website for their future references as well. I would like to thank everyone once again for making today's webinar a success. I also extend my thanks to KSSCA and the event organizers for their enormous cooperation in the organization of this event. Thank you.
Thank you.